Hello, everyone, and welcome to the Hardcore Finance Show with Alex and Shimon. Today, we have a very exciting topic to discuss, which is whether what we're seeing right now will continue or whether we'll revert to the mean. So, Alex, I wanted to hear your opinion on this. I recently heard the All In podcast with Chamath and David Sachs and Jason and all of these guys, and they had Friedberg, and they had a summit where they interviewed Bill Gurley, and Bill Gurley said something very interesting. Basically, I'm reading all of the Twitter sphere, all of the economic thought leaders, and you can pretty much split them into two camps. I don't know if they're equal in size, but two camps. One camp says we are really screwed because last time that the Fed tried to raise rates and the markets collapsed, they really quickly said, no, okay, we'll lower the rates back down. But that was at a point where we had no inflation. So now they can't lower rates because that would create a lot of inflation. But they also can't keep the rates high because then they'll default on their debt. And we spoke about that in previous shows. But then Bill Gurley had an optimistic view, which I'd never heard before, which he said, look, guys, inflation is coming down because once you start overlapping with last year where prices were high, basically there were a bunch of stuff that happened in COVID. People got a lot of money through stimulus checks, but the supply chains kind of broke. So that kind of broke prices. He just said prices are a signaling mechanism. It kind of broke. But like now, it will come back down. People will figure out how to manufacture things. And yes, there's war in Ukraine and commodity prices, but those are like individual incidents. Overall, as the CPI will go back down, which means that the Fed will be able to lower interest rates, not default on the debt, and the markets will keep pumping. So which of these two theories do you subscribe to?
I was just listening to you say this and just kind of try to take it in. I think I need to hear the podcast. There's a lot of what you said that is hard to disprove because if you take a long enough time horizon, then of course it will happen. So for example, there is war and we can figure out how to innovate our way out of these inflationary things like food shortages. Yeah, we can build and plant in the US. It'll take a year at least, right? Maybe 2 or 3 at the very least to at scale, let's say, move farming over to the US. Then you're gonna think about, okay, well, we're gonna resupply chain, right? To not be so dependent on others or kind of nationalize or bring things inside the various countries. We're gonna back up.
Army load up baby formula on planes.
Yeah, exactly. From Germany, right? So, but we have all these supply chain dependencies where we're going to reevaluate them. That takes years. So, of course, after a certain point, inflation will come down. That's one. Two, there's a base effect. Yeah, when your inflation is high, and then next year compared to this year, which is really high, it'll look like it's not increasing at all. But it's just a base effect. It's not. Inflation can stay sticky, right?
No. Here I have to disagree with you. I completely agreed with you until now, but the whole point is that if you don't have inflation, right? Let's say the prices stay sticky at the current levels, but they don't keep increasing.
Yeah,
that can allow the Fed to lower interest rates, and that would be
sure. And then sure, fair enough. But the economy is still heated, right? What's the Fed doing? What's happening now? I mean, now is a very unprecedented situation in many ways. We have inflation, yet the economy is doing quite well, although starting to see some kind of cracks. But the economy is doing quite well.
Unemployment low, which is very
unemployment's low.
We kind of broke right? People thought that actually, you could have inflation and low unemployment. You could have that because that means that wages have price pressure. So
you could have it. The other thing is, it's like everything is getting crushed in the markets. Everything, because the markets can't figure out whether the Fed put the stopgap essentially when the Fed freaks out, the markets are falling too fast. where that's coming in. We have bonds that have been being. It's weird. It's like on one hand they're bought up, right, because the Fed is doing it. On the other hand, the Fed stops, nobody's buying the bonds, and then free fall. But after a certain point, when you get capitulation in the markets, typically you see a sell-off in stocks and you see a mad rush into bonds, so yields fall. That's like when people are just flying to safety. That's not really. It's such a weird environment. Plus, if there is a recession, I know I kind of went on a tangent, but if there is a recession, earnings will compress. So now you have multiples compressed, earnings will compress, the market will get hit. I don't know. I guess maybe I'm in the doom and gloom camp because his whole argument, it seems, of it'll get better later on. It will get better later on because of base effects and because at some point inflation will go down. The question is how much, right? And will the Fed reduce rates? I don't know. Like, where's the break even? Is the break even at 4% or 5%? And the Fed, they'll keep rates at 3 or 2.5 and keep them there for a little bit. Plus, there is another aspect to this whole thing because the war, inflation isn't just caused by, the monetary policy of just printing. It's also caused by supply shortages. So you can slow demand all you want, but if the problem is with the supply chain shortages, and those aren't getting unclogged because China's being stupid in COVID and because there's a war, then the Fed can't reduce rates, right? Because those things will still remain, even though they're technically transitory.
Yeah, I don't think that I buy the supply chains being a long-term problem. I just can't fathom it that we can't figure out how to make stuff. You know what I mean? Like, we have enough stuff. It's just a matter of like distributing it to the right people. So we have enough energy, we have enough calories, we have enough everything.
We don't have enough calories in America, but there's going to be starvation now because of what's happening because of the wheat now coming out of Ukraine.
Wheat is a weed. It grows in 3 months. So yes, China was smart and has like 16 months or 18 months of reserves, and other countries are not smart and they don't have wheat reserves. But again, that's a very short-term thing. Any problem with wheat can be resolved in 6 months. By definition, you plant it, 6 months later, you have a crop. So I just don't buy it. Yeah, specific countries can mismanage their policy and whatever, but I just don't.
But if you're in Africa and you don't have the fields, do it or the infrastructure to do it.
So I guess my point is more on a global level.
Yeah.
Of course that individual countries can have huge problems, and it's heartbreaking. It's a tragedy that in the 21st century, we can't figure out how to give enough calories to everybody on earth, for sure. But I'm talking about the stock market. I just don't see any inherent supply chain issues. Even I just interviewed somebody from Hong Kong. They're like, yay, they're letting us go to restaurants again. You know what I mean? So even countries that are crazy with lockdowns, they can't continue forever just because it will destroy the economy. So I think that I personally am less worried about supply chain issues. I'm more worried about inflation that can come from other, from other policies.
Wait, sorry. Before you go on, can we talk about your time horizon? Because you said it will solve itself. What's your time horizon? Are you talking about 6 months, a year? How many years?
1 year.
No, but in 1 year, supply chains can't resolve themselves. It may be not to the full extent. Not like we just start making stuff in the U.S. or start making stuff in Europe. You can't just make stuff. Chips, lithium, getting lithium out of the ground, right? So like Russia, nuclear. Oh my God, the isotopes. Or uranium. Yeah, Rosatom provides a lot of the uranium to the world. What, they don't give us uranium? What's happening to our power plants? I mean, there are certain things that are, decoupling a globalized supply chain takes some time, 5 years, 10 years, until we're fully back up to speed to decouple and rebuild.
Are you expecting inflation to stay consistently high for 5 years?
I'm expecting inflation I hope inflation falls down to 4.5%, 5% kind of top line this year. I don't know what 3% core. And then stays there. If it stays there for another couple of years might be okay, and then maybe in 24 it'll start coming down. But again, I don't know a lot of these dependencies. Fuel and nuclear fuel doesn't necessarily drive. It will drive some increase in energy prices, but you can substitute nuclear for natural gas. Let's say it's not a huge cost driver. But I don't know what these other industries that are like this are. Chips getting new cars. Okay, that creeps up a bit, right? Used cars. Computers might cost more from chips, right? So is that going to slow down is that going to increase the basket overall? I don't know. Not as much as freaking, gas.
Yeah, like energy is a huge problem because it's an input into everything. But I mean, I don't know. Again, I just think that on a global level, if we ignore individual industries and if we ignore individual countries, I just don't think. I mean, another way to think about it is like, imagine if we kept it 7% or 8%. How many years can you stay at 8% without like breaking everything?
Inflation?
Yeah, because we're not Venezuela. I'm talking about like global inflation, like global price inflation. So it's like, 10 years of 8%, it doesn't make sense,
Well, what do you mean it doesn't make sense? I mean, it's just very bad. It makes sense to me. It could happen. It's just terrible. I mean, you're wiping out, and I don't know if it will be global on average. Let's say the US is 5. Yeah, maybe that's 8 on average global weighted for the economy. Yeah. The interesting thought that I heard, and it's an interesting actually bifurcation. Like, does printing money cause inflation? My answer was, of course, yes, but it's actually more nuanced than that, right? It's like that inflation technically isn't money printed. Inflation technically is supply and demand changes. Money printing goes into capital assets. Typically, there's inflation there. But true CPI inflation is, how does that money printing trickle down into supply and demand? Does it overstimulate the economy, overstimulate demand, which is what we typically think of. This is why helicopter money just gets everything going. Everybody's running, buying the same thing. But a lot of times it goes into capital assets. So money printing isn't necessarily the cause of kind of CPI inflation, but its actions thereafter are. And I think now we're hitting these actions post-COVID, because during COVID, there was nothing to do.
Yeah.
Which is why, you have these high tech stocks bid up. But again, it's not like more people aren't paying for Microsoft. This is, so when the whole tech sector takes a hit, I know I'm kind of going on a little rant here, but the whole sector takes a hit. It's a bit frustrating because it's like, okay, well, people are staying at home when they're using these checks, so this money, and they're saving their money, so they're going to do something. Okay, I'm going to buy a Peloton bike, right, which I'm going to use now, and now I can go out and I'm never going to use it again. I understand Peloton getting hit, but like Microsoft, what? You're not like sitting at home like, oh, I'm going to buy more Microsoft Office. No, it's like you're working, and then like Google. I mean, I could sort of see a little bit of Google. Okay, it's a recession. Ad revenue is going to fall.
Sorry, just to be devil's advocate, I mean, Microsoft is a company that has a tremendous footprint, right? I could see them, going up in value a lot. Like if you look at all the cloud services that, everybody's using, LinkedIn, stuff like that. Like, so I could totally see that. But again, this is short term. The question is long term, like a year from now. I really think that the everything will kind of revert to the mean, and the mean has continuous growth. And the question is, will we be able to pay off the debt, or will we have to have some sort of debt jubilee, which will be extremely painful no matter how you do it? Like
debt, what did you say?
Debt jubilee? Have you heard that?
Oh, I thought you said like it. Never mind. I thought you said something different. I never heard of that term. Tell me, what is debt jubilee?
No, I mean a debt jubilee. It's something from the Bible where like emperors and kings and stuff used to like forgive everybody's debt every like 50 years or so.
Jubilee.
Yeah, but I mean, my point is, they can achieve an effective debt jubilee by two ways. One is to inflate away the debt. So basically, if prices double, right, then the debt is just like half in terms of debt to GDP.
For sure.
Really, they can do that. And then we can talk about, is it catastrophic that a house that costs $1 million today will cost $2 million, like in a couple of years? Will that be catastrophic? There's also a new phenomenon where before the different currencies would balance each other. So if someone would print a lot, their currency would weaken. But now I think all the central banks are coordinating. So like literally now, the Central Bank of Israel raised interest rates. Why? Because the Fed raised interest rates, right? Nobody has an independent economic policy, or at least monetary policy. Fiscal policy, maybe every country can do their own thing. But monetary policy, I think it's just like
it's a little bit like ECB was holding, but now they're going to raise. It's like on the margin. It's like plus or minus half a year.
Exactly. So it's like, do you front run it? Do you do it after you have no choice? But like at some point, you'll kind of do what everybody else is doing. But so that's one solution. It can be beautiful. Ray Dalio talks about it, right? It's like just like a deleveraging of the debt, and then you enter another cycle. But another way to do it, right, is if they just don't print the money, then people will just have to start defaulting on the debt, which will just like crash prices. So we have like a deflationary solution and we have an inflationary solution. What's for sure is that there's no solution where everything stays as it is. My argument would be that even in a deflationary solution, as long as people don't have too much debt and they get margin called and stuff, we could just unwind it and then keep growing. I mean,
yeah, but how long does that unwind take, do you think?
I don't know. It depends on what governments do. Like, it's really hard to predict because I could predict things if it was just like we could base our decisions on history, but we can't really base it on history. So
yes, this is going to be a monumental unwind.
Yeah.
I mean,
like either way will be monumental. Whether it's an inflationary unwind or a deflationary unwind, it's going to be monumental. The question is, how do we position ourselves to benefit from it? And I think my best guess currently, since we missed the energy trade and we missed the commodities trade, it's just a matter of like buying some kind of assets that are productive, whether it's stocks or whether it's real estate in areas where it yields you
cash flow.
Yeah, exactly. And then you can adjust the cash flow. If there's inflation, you raise the rent. And I'm assuming that stocks also have the same pricing power of just like increasing. Costco just increased the price of their hot dogs, right, from $1 to $1.50 after like 30 years.
Listen, so an interesting idea I heard recently: U.S. farmland. There's and so I was thinking, like, what are the effects, right? For sure, because of this, we're going to domesticate some agricultural, I think, production, and we're going to, NATO is going to need to be rearmed. So I think defense and this whole farmland idea is pretty interesting, actually. Very interesting, because it's literally productive land. There's an ETF on it.
Yeah, the question is, do you think it will outperform the like S&P 500? Because like you're getting exposure to these things on the S&P 500.
Yes, I do.
So
we're talking about sectors, right?
That's the thing. I don't know. First of all, about countries, I'm the most bullish about the US. Like with this war in Ukraine, it's like really good for the US because we have energy, we have food, we have everything. Maybe we don't have chips, but that's okay because, like, Taiwan, I think it's...
Oh, I thought you were talking about potato chips. You're like, we don't have food. Maybe we have chips. I'm like, whoa, they're kind of made here, Frito-Lay. And then I realized, not the right chips, Mr. Ibada, not the right chips.
No, but my point is still, like, if you had to bet, on a country, I would totally bet on the US. Also, we have like geographical arbitrage like within the continent, which is pretty amazing. So yeah, I mean, I don't hold any other stocks that are outside of the US. The US stock market has been outperforming all the other stock markets so far. So I don't know. I just don't know. Like, even if I were to believe your doom and gloom scenario, like the question is, how do what do you do? What do you do with the market?
What scenario do you believe?
So I really think, being the optimist that I am, I really think that basically inflation will come down. I basically think we're going to have a repeat of 2018. Inflation will come down. There's going to be a huge relief rally. On the All In podcast, they were talking about it. Look, the price of a used car was $20,000 forever, right? If you just like remove the normal CPI, a used car costs the same. Suddenly now it costs $28,000. Like, why wouldn't it go back down to 20,000?
By the way, you said a relief rally. That's typically a bear market rally, and it's going to go down further.
No, I mean relief in the sense, not the technical analysis. I just mean people will be like, "Oh, we were expecting inflation to be higher, and then it's actually lower."
Oh,
so they would price in the fact that the Fed would lower interest rates and so forth. That's what I mean, and I really think that that's in the cards for us. I have no way of predicting it, but I don't know. I just think that very, very smart people are working on this problem, and I think it's only a matter of time until they solve it.
Which problem?
The economy problem, shit show that we're seeing right now. So like, no, because the issue.
I'm not as optimistic.
Well, another thing that I wanted to say before I hear a pessimistic take is like, look, 2008 was a specific error, right? Which was like, people were getting mortgages that shouldn't have gotten mortgages. They should have rented instead. 2000 was a specific error, which is like there was a new technology. People did not know how to price it. And so the bubble was crazy up and then it crashed like crazy. Now there's no particular error in the economy. It's just like a bunch of things that just happened together. But it's not like you can point to...
I know.
Yes.
How about an exorbitant amount of debt built up in the system?
But do you think it's exorbitant? Is it more than normal?
Yeah. I don't know. We can look at just our deficits. I know deficits are 30 trillion.
After World War II, I think the debt to GDP. Let's see here. USA debt to GDP. So I'm looking at the chart here.
I think it's like 3-4%.
Sorry?
I think it's like 3-4% now. I don't remember how much exactly. What's it usually?
Currently is 133%. It's the current one is 130, and it's projected to go up to 133% by 2026. But
What am I talking about? 3 or 4.
I need
thinking something else. I was thinking about deficit. I was thinking about the federal deficit.
Yeah. Okay, so here we go. Okay, I'm looking at a fascinating chart, which is
share that screen.
Can we share the screen?
You can share the screen, but for the people listening to the podcast, we will explain. I'll explain the chart. Can I be the chart jockey?
You can.
Show the chart.
So walk us through this chart.
Beautiful, beautiful. Okay, so we have a chart of U.S. debt held by the public, percent of GDP from 1790 to 2021. This is meaningless. This is by the public. But there's...
I've seen similar charts for just overall debt to GDP, so I think it's a good
No,
indicator.
because there's stuff held by China, stuff by foreign corporations. The Treasury holds more.
I think this is directionally accurate because I was about to say before I shared this chart that we have had higher debt to GDP, and that was after World War II. And that's what this chart shows. So
that was World War II.
Yeah. So at 120% of GDP held by the public, World War II, we still have a way to go. And then they had an economic boom, post-war economic boom, that basically paid off the debt. Okay? And so my optimistic scenario would be that this thing repeats itself. Like the COVID line, the continuation of it is exactly like the World War II line.
So basically, this says,
If that happens, the stock market is going to pop like crazy.
but the only way this happens is if all of a sudden we have a couple of years of productivity and we see the growth is not stalling. The worst thing that can happen for the economy now is stalling growth. Well, not the economy, stock market, for everything.
Yeah, that's for sure. And that's the question. What do you think? Like, what are the forces that are pro-growth and what are the forces that are anti-growth? Like, anti-growth is the huge levels of debt. So you have to like spend money on paying off the debt instead of investing it in stuff that can make you grow more.
Regulation.
Yeah, regulation, but I mean,
Well,
regulation could be reversed.
exactly.
That's what, yeah, so that's what I'm saying. Like, smart people are working on this. Like, if really some of
The other party's getting elected on this.
well, exactly. So it's like, if you're Biden and you have very high gas prices, you know that you have to lower the gas prices. And we have things that we can do, like approve drilling on public lands, sell more leases, build pipelines. Like there's many things that we can do within America that are not dependent. Like Europe is really screwed because Europe really needs the Russian energy, and they really don't have a better solution within the next 20 years because it takes like 20 years to build a nuclear power plant. So they really don't have a good solution. But for the U.S., and when I say gas prices going down, I mean, what if like inflation now over the next 5 years is 100%, right? But the gas prices stay at $5 per gallon. That would be them going down in real terms. And that's like the debt jubilee I'm talking about. That's the unwinding I'm talking about. Like everything doubles, but gas doesn't.
Because it's cheaper to make, cheaper to produce, and so on and so forth.
Yeah.
Because
I mean,
inflation.
like some people in Europe currently are paying so much on energy, it's almost like the price of their rent. Like it's insane. If you have like if you live in a poor part, if not in a big city, and you have a big house, I heard that some of the heating bills and so forth are more than the rent. So it's they're in big trouble. I would not invest in European stocks.
Yeah, Europe, it just seems, I don't know if there's a lost decade or lost whatever, but they've lost their cutting edge. They were maybe like since 15 years ago, mid 2000s, definitely post 2010. It's just kind of, they've been on a decline from a regulatory perspective.
They've lost their edge after the Berlin Wall collapsed. That's how I see it. Because like until then, they had a reason to work really hard and to outcompete the other
What
bloc.
about afterwards? Then the euro was introduced, right? Then everyone came onto the euro. That was a big deal. Then the euro was high. I remember when it flipped the dollar, and then it was talking about being the euro being the reserve currency of the world. I mean, they had a little bit of a early 2000s spot in the light. No, I feel like that was maybe like the height.
Yeah, I don't know. I'm not a Europe expert. All I know is that Europe and Japan, I wouldn't bet on them. And no, and also they have very low birth rates. It's a correlation. Like it's a correlation. Like it's hard to be excited about bringing 3 kids. Like you really need 3 kids in order to grow the population. 2 kids is just keeping them at the same level. So like to have 3 kids, you need to be excited about the future. And it's really hard to be excited about the future when you don't, when you have high unemployment and so forth. So
That's an interesting point. That's an interesting point about that. It's an interesting way everything ties back together through human emotion. That's why I do technical analysis. Oh yeah, plug.
Cool. So before we just close, what do you think about the crypto world and Bitcoin? How what's
cannot. I can't. My poor heart strings are taut, and they're singing a melody, a very sad melody. I can't talk about crypto. I can't.
Yeah.
It's terrible. I mean, Bitcoin, basically, this is like, come into Bitcoin to hold Bitcoin. That's the safest thing now. Ethereum, maybe. Um, Senator Loomis tweeted out a little bit ago that, her bill is coming June 7th. Like, thank God, let's get some free. She's putting forward a crypto framework through Congress. Apparently it's bipartisan. It's kind of weird, bipartisan, both pro and bipartisan against, but, whatever. Hopefully they pass it. Just like regulate stable coins already. Some of the stuff that's out there is very sensible. Regulate, just tell us what you want us to do and we'll do it. I mean, like, a sensible regulation is fine. Don't outlaw stupid shit like proof of work, but just have an audit, no problem. Like KYC, no problem.
I know. You know what's crazy? Now in Israel, I heard the news. They are working really hard to lower prices because their inflation is worse than the U.S. And like, we're gonna remove barriers between banks. So in Israel, there's like 3 main banks, and each of them have their own version of Zelle. Zelle. So each has its own Zelle, where you can transfer, between people just by sending their email address instead of like having routing numbers and stuff like that. And so then the government was like, we're going to force the banks so they're each will talk to each other, and you can transfer between banks for free. It's probably going to take 5 years.
Just use Bitcoin.
Or a stable coin. Forget about Bitcoin. Just like use a stable coin.
Well, I mean, Lightning on Bitcoin, you're not exposed to the thing. Or use a stable coin.
I'm saying if you're the government, just do a stable. You don't even need a CBDC. Just start by having a stable coin.
Yeah.
Just literally any stable coin. It doesn't have to be programmable, anything. And then people can transfer it between themselves. Like, it's insane to me that we haven't. We have the solution. We have the technology. That's it.
It works.
Just regulation. But anyway,
I know.
So that's my optimistic point, that there's still a lot of inefficiencies, and sometimes necessity is the mother of invention. Like, we really can be more efficient, but we just didn't have the impetus. And that's probably the biggest optimistic take that I have, which is like, again, desperate times call for,
Well, we got some impetus, all right. We got some impetus for the last 6 months.
It's true, though. It's really true. I mean, people said, again, on the All In podcast, something like 18% of global wealth has been destroyed over the last not many months. And so it's like, okay, now's the time to act. Now's the time. And by the way, COVID made us much more productive in other ways. But like, it was just wasted by sending checks to people. Like, in San Francisco, I had some academic friends who don't, they don't work in tech. Yeah. They're like, I make more money on my stimulus than I used to work while I'm going to the university. Now, it's not like someone who's like working at a gas station. It's like PhDs. And they were still making more money on their stimulus.
Crazy.
So it's like, that's what I mean. Things were not normal over these last 2 years. They can just go back to normal and keep chugging along.
Well, here's to chugging along. Cheers to you. Please like, comment, subscribe, comment, tell us what you would like to hear, and visit hardcorefinance.com.
Yeah, good to talk to you again, Alex, and let's see how the events unfold this week.
To the moon.
To the moon.